Well, joining us now is Paul Mirren and Paul Miliotis from Msquared Capital. I'm going to do a bit of a catch up on what they're seeing in the real estate market right now. We're starting to see a bit of a slowdown, but prices I think are still rising. But let's just see what their crystal ball is telling them for 2022 and right now. Thanks for joining us, guys.
Thanks.
Thank you.
Peter.
Okay. Anyone who watches this show caring about property want to know what's going to happen to property prices. So Paul Mirren, what do you think is going to happen?
Well, there's been some really interesting economists come out just recently saying, look, we see a bit of appreciation, probably 5% in the next year or so. Interest rates will go up, and then we'll see a decline of 20%. Look, I've got a bit of a different point of view. I think the fundamentals of property are pretty strong. We still have a shortage. Migration will come in and create a high demand. So, and I think that people with the expectation of thinking that property will go down, I think what we're seeing right now with more properties on the market right now and clearance rates falling, I think the appreciation might be very moderate. So it might not go up 5%, and it might not go down 20%, but I think it might go down 5 or 10% over the next 2-3 years. So I think there are still a lot of fundamentals in relation to in the market, which with shortage of property to keep it up a little bit higher than what people expect, even with interest rates going up a little bit.
Yeah. So I know when you look at the charts for, say, for example, Sydney real estate, we tend to go up, then go sideways for a while, then go up again and sideways a while. Though the fall between 2017 and 19 was much more substantial. Guys, why do you think that happened?
Well, it happened because it was macroprudential authority. So it was an artificial way of actually, people wanted to buy property, prices could go up, but because banks weren't giving money to people as easily, and the perception, you have to also think about animal spirits. People are saying, well, if it's too hard to get a loan from a bank, maybe I should put off the purchasing right now. So all those combination actually resulted in the property market falling. In fact, in 2017 and 18 was the only year that we actually delivered more property to the market than demand as well for the last 2-3 decades. So that's another reason why you had that element.
And also Bill Shorten, leading the Labor Party, was promising to change negative gearing.
Yes.
And capital gain discount rules, which I don't think we're going to see with this election coming up in 2022.
Well, yes. Now that you mention it as well, I'm not sure whether the macroprudential authority was a counter effect to the political aspect of it, but the Bill Shorten effect to property prices. But right. I don't see that the Labor Party will be running such policies in relation to anti-property. Let's call it that way.
Exactly right. All right. So, Paul Miliotis, what are you seeing out there right now, which you'd like to inform my audience about?
Look, we're seeing a big flow of capital come into our sector, Peter. So a lot of the investors are telling us they're liking the fact of what fixed income styled products offer. For our investors to lose money, we've said, look, in the 2017-18, the property price in Sydney might have dropped 10%. We're suggesting maybe a 10% decline in the next 2 years. There's a bit of caution when you're buying property, but when you're investing or taking a mortgage over property, it's a lot more defensive than looking at the property prices alone. So when we're lending in our sector, our investors provide us with capital and we lend them to borrowers. They share in the interest income. For them to lose capital and lose their monthly returns, the property prices need to drop by about 30-35%, which, you know, while it's a consideration and it is more risky than having your money in term deposits, we are finding that there is a flow of capital because they're loving the return of being paid monthly. And we're returning around 7%.
Yep, on average.
On average on 7%, and we're secure. We're a secured lender, so we're securing against property. So there's a flow of capital which we haven't seen. The last year, I think we've close to double our funds under management because the sector is being it's a good sector to be in a defensive way.
So 7% is a great return, but we have to emphasise it's because there is the risk that something strange might happen. property prices might fall by 35%. And that would mean that anyone who borrowed from you, if you wanted to get the money back to pay it to the people who lent it to you, when you come to sell their residential property, you might not get it. So less would come in. That's the risk that people take when they go outside of term deposits.
That is definitely the risk. And that's why when you're investing in this sector, you need to understand exactly what you're doing. It's not horses, like not one mortgage is the same. So you might you need to look at what the underlying security is. If you've got a farmland in Bundaberg and you're lending the person 65%, in a case of a shock, to sell that farmland takes you longer. There's not as many people that want to buy it. So your risk of a decline of property value is higher than if you, for example, took a residential property in Mossman or somewhere within 15 k's radius of the city. So when we're talking to investors, understanding what you're actually investing in the mortgage space, I think is critical.
The other thing that we're seeing a lot of flow into our sector as well, people are taking profits. People are taking profits in share market. People are taking profits in the property market as well. And they parking money in our sector because it's a medium term. So for the medium term of parking money with us, they're still getting 7% return. And then they may choose to go back in the market after a 12-month period, buy stocks, buy shares, and rebalance their portfolio. So we're seeing a lot of rebalancing of portfolios for sophisticated investors at the moment.
Yeah, and that's the point. You are talking about sophisticated investors. I've never asked this question of you guys before. If someone wanted to get out before, an appointed time, what happens?
Look, with our sector, it's after the GFC, what they did, they put in some controls that doesn't allow a flow on money. So it's not an at-call investment. So you need to be careful that the term is adhered to. But from time to time, we might have an investor that is in a difficult time, and then we'll do whatever we can to effectively sub out that investor with another investor. In saying that, you can't guarantee the liquidity outside that term, but in our business, we've been quite successful there are traumatic times in people's lives, and we like to try to help them.
But the benefit is that we have mortgages that are 3-month mortgages, 6-month mortgages, 12-month mortgages, 2-year mortgages. So if you know that liquidity is something that you want to manage, then you diversify into different type of transactions, being 3 months to all the way 2 years. So you always know that you have a certain amount of money coming back to yourself.
Another important point I'd like to flesh out with you guys, because a really important underlying assumption of your business is that real estate prices have to fall by 35% before there could be a concern. But when we say that, say Sydney house prices fall by 10%, some suburbs could fall by 20, 25%, and others might actually rise by 5%. So your selection of who you lend to is critically based on what you think could happen in worst case scenario in that suburb for that property, I guess.
Look, there's a reason why we haven't lost $1 in our history, Peter, and the analysis behind where the property is one aspect of what we look at. Now, while it's a very important aspect because you always rely on that security, what we've found is our other algorithms behind it are people that have borrowed before and in our sector know how to get themselves out of trouble if things like a downturn of 20% happen. We've lent money during the GFC and we didn't lose money in that time too because the people were resilient. They sold property when they needed to sell property to divest. They knew how to earn money to be able to pay their interest, and they did everything they can to pay their mortgages. So it's more than just security, it's character of the borrower, it's their cash flow, it's what else can they do in the case of those black swan events that you don't know about. How can they make sure that their mortgages are paid and they don't have to sell?
Okay, final question. This probably comes back to you, Paul Mirren, but if, Paul, you want to add something to it. So if I look at the forecast for 2022, and I've got Reserve Bank growing, saying the economy is growing at 5%. You've got Treasury a little bit higher, I think. Bill Evans from Westpac saying 7%. If that scenario works out it should be an okay time for a business like yours.
Absolutely. So look, when the economy is growing that quickly, the demand for money for people to borrow, businesses to borrow to expand their operations is quite good. So we've seen a constant amount of good quality transactions all the way through. But yeah, we're looking forward to next year. I think we'll have plenty of opportunity to lend money. Absolutely.
Well, last question then is what are the curveballs that you're watching carefully that could make life tough for a business like yours?
Look, everyone's talking about the same thing. It's inflation, interest rates going up, and having a bit of pressure on asset prices. Now, even if that happens, the demand for money is still going to be pretty good. Investors are still going to get good returns on their money. So even though interest rates might go up, let's call it 0.5%, your term deposit rate might go from 0.1 to 0.6. We're still offering 7% on average on 65% geared transactions through our fund. So it's still a very attractive proposal.
So the people borrowing from you must be, figuring they're going to do a lot better than 7% if they're effectively paying you that kind of money.
Well, that's one thing, Peter. The other thing is sometimes people don't have an option. They might have bought a property with a 6-week settlement, and then the banks will take 6 weeks to even get close to an approval. So it's one thing that it's not just people that are developers that come to us. It's also people that need to bridge a gap between what the banks are providing in terms of speed, in terms of understanding their situation, and that is another key factor why borrowers come to us. It's not just developers that want to do more with their money. Sometimes there's other needs.
Yeah, great stuff, guys. Thanks for joining us. Thanks for contributing to the program over the year. Have a great Christmas, and we'll see you in the new year.
Merry Christmas.
Likewise. Thank you so much.